October 18th. Will the clerk please call the meeting to order?
Chair Du Bois,
Here.
Vice Mayor Ku,
Here.
Councilmember Philstaff.
Here.
All three present. Thank you.
Great. First item is oral communications. For members of the public to speak to something not on the agenda. Do we have anybody tonight?
Chair Du Bois, we do not have any requests to speak.
Great. All right, so we have one action item tonight. It's a review of our pension and OPEB Section 115 trust funds. Kylie, you want to take it?
Sure. Thank you, Chair Du Bois. Good evening, Finance Committee. Kylie Noze, Administrative Services. Tonight, we are in our second step of a multi-step process to take a more in-depth look at our long-term liabilities and strategies to address those. So I will turn over this item to Jesse Deschamps, our budget manager, who's here with also Paul Harper with our budget team, and they will go through the choreography for this item.
Sure, we're going to start with a really short staff presentation, just kind of a couple slides to orient everyone to this item, followed by presentations by both our CERT and PARS representatives. So we'll just get started with the staff presentation. Great. Next slide, please. The City Council adopted pension policy is outlined here. Overall, the goal is to reach a 90% funded status by fiscal year 2036. This is a 15-year time horizon since the adoption of the policy in 2020. Funding components include a lower discount rate for normal cost as compared to CalPERS. Currently, the city is using a 5.8% rate as compared to CalPERS 6.8%. Additionally, contributions are made from excess BSR when those levels are above City Council targets. The use of funds, such as transmission of funds from PARS to CalPERS, requires City Council approval. This also includes reporting requirements. This includes actuary analysis every 3 years to inform the progress of meeting goals. Also, regular status updates and annual contributions in the budget process. As Kylie mentioned, this has been a 3-step process as part of reporting requirements. Staff has scheduled several meetings with the Finance Committee this fiscal year to review pension and retiree healthcare plans. This includes the review of CalPERS actuarial analysis as of June 30th, 2021, which was brought forward to Finance Committee in September 2022. This evening, which is the review of the current status of pension and OPEB liabilities with the plan providers. And upcoming is a review of comprehensive actuarial analysis based on alternative assumptions, including potential policy revisions for City Council consideration. And this is tentatively scheduled November 29th, 2022. Next slide. Areas for Finance Committee feedback include items on investment diversification, such as diversifying asset classes to hedge against impacts from similar negative events, investing in a more conservative asset class when actuary recommends disbursements or funds reach a 75 to 80% funded status. These funds can also be used as a rate stabilization or a reserve to smooth volatility in employer rates when they change year over year, or act as an emergency source of funds or a rainy day fund if there's a difficult budgetary or economic times. And then lastly, these funds may be used to make liability payments. This is done through an additional discretionary payment or ADP to CalPERS to pay down the liabilities. Of note, the funding policy contemplates an ADP for funds in excess of a single year of employer contributions. The funds are expected to reach these levels in 2 to 3 years. So the action this evening is to review and accept the status update of the city's pension and CERT funds, discuss variables governing these plans, and provide feedback and potential policy changes moving forward. So with that, I believe we'll turn it over to our CERT representative, Matt Goss.
Thank you, Jesse. Good evening. My name is Matt Goss. I work for CalPERS. I've been working on the city's behalf since 2010 to help you with your OPEB pre-funding goals related to other post-employment benefits, including primarily medical for retirees. On slide number 2 of our presentation, we have a brief OPEB plan summary, and once that's up, I'll start speaking to that slide. Thank you very much. Appreciate it. So the most recent actuarial valuation report for OPEB that the city has had produced for them is as of June the 30th, 2021. And the total OPEB liability as of that date for the city is $244 million and change. That's using a investment return assumption or a discount rate of 6.25%. Your assets as of the time of producing this report back in September on the 14th of this year were almost $146 million. Your funded status from that valuation report going back to the summer of 2021 was 67%. Next slide, please. So one of the things that the city has done is OPEB liability mitigation strategies. And there's 4 main things that I wanted to review briefly. The first of those is the utilization of a discount rate for SERP contributions that is different, than the one that you use for liability calculations that I just shared with you on the prior slide. So for those contributions, you're assuming a lower discount rate, which means those contributions are larger. And by entering money earlier into the investment vehicle, you'll save money later by investing more principal now. In addition to that, you reduced your amortization of the debt that you have, the unfunded accrued liability, from a period that was 22 years down to 15 years. And the goal of that 7-year reduction in time is to pay down the debt faster and save money by doing so. You also piggybacked off of the good results that you had in the 2021 fiscal year and assumed a 0% return in the 21-22 fiscal year. And that was a good move because actual returns were even lower than 0. So it was helpful to do that. And then finally, you're contributing $400,000 more each year for new staff to get the ball rolling a little bit faster with them. So these are the 4 mitigation strategies I just wanted to review and remind you about. Slide 4, please. What I wanted to share with you briefly is what I see as the short-term future for OPEB plans. This is not specific only to the city of Palo Alto, but rather to all agencies that are doing this more or less. What we've been seeing is a trend that has capital market assumptions less favorable now than they were before. That's particularly the case between 2022 and 2018 at CalPERS when we did that work. This means that expected returns project lower and risk projects higher. And this creates a situation where it's more likely that actuaries doing OPEB valuation reports will use lower discount rates, and that would make liabilities higher. So SERP assets over that period, went up, but then they have declined since the beginning of the 2022 calendar year. And that unit devaluation, I say that because you still own the units, but they are worth less today than they were back in December of 21, is due primarily to market volatility. And that volatility was in both stocks and bonds. This also means that funded statuses will almost certainly be going down in the short term. Short term for me here is 1 to 5 years or so. And that will mean that contributions will possibly go up. And if you don't want to pay those higher contributions, which you're not obligated to do in the OPEB space, your investment time horizon would get longer. So these are some things to think about and consider when addressing policy. Next slide, please. 2 points here to mention, they're bolded for you. This is a snapshot of your two most recent OPEB actuarial valuation reports. And what you can see in the total OPEB liability line is that the liability does go up from one report to the next currently. It went up from 241 million or so to 244 million or so, but not by a large amount, but it does go up. So I wanted to remind you of that. And then your contributions that are being recommended by the actuary actually are going down, and that's because you're paying your debt down quickly. And as of the time of that 2021 report, you had reduced your net OPEB liability, which is the debt on your financial statements, by about 40 million. So that's why the contributions went down primarily. Next slide.
That's a good question on that slide.
Yeah, if we could go back to slide 5, please. Go ahead.
So the normal cost, 7.099 million there. What discount rate did you use to calculate that?
Actuaries that did this work for you at the time, Bartell Associates, used a 6.75% discount rate for that.
Okay.
That was back in 2019. They reduced that down to 6.25 in the 21 report in the column to the right.
Yep.
And that went down to 6.25, and the normal cost actually went down.
I was gonna say you reduced the discount rate, the normal cost went down.
Yeah, and that could just be because of the age of the active employee population. So when they do median ages to retirement, and they look at all types of plan experiences, that can actually happen. What I would do is talk to the subject matter expert on that, which would be your consulting actuary.
Okay, thanks.
Yeah, it's a good question.
Can I ask a quick question
just-
here too.
To Chair Du Bois, one, if I might just answer, I think Councilmember Philseth's question. One of the other impacting factors in our most recent valuation impacting normal cost was actually the cost of healthcare. And those assumptions went down significantly in our last OPEB report. In fact, our actuaries had said in our last OPEB report that the lower assumption for the cost of healthcare was equally, if not more important than the additional earnings in the portfolio from an asset perspective. And so those are the kind of two main variables when we went over this in May, I think, that really impacted. Now, they also noted that we don't know if these are trends or if they're blips because of COVID, which is why we took those risk mitigating strategies that the council and this committee reviewed for budget adoption. Apologies for interrupting. Chair Du Bois, you had a question?
Yeah, no, I need the help being remote tonight, so thank you.
Yeah.
I'll try to jump in when I can. So in terms of our actual payments, what's our policy? Do we make the actuarially determined contribution, or do we pay more in a year?
Sure, Jesse can get the specifics, but we do pay more. So we always pay the actuarial determined contribution, and Matt had a nice term for it. We pay at a more conservative discount rate than that, so we pay more. What did you call that contribution?
Yeah, that's referred to as a margin for adverse deviation.
Thank you. His fancy margin for adverse deviation term. So we do contribute both in OPEB and pension additional costs to account for the margin for adverse deviation, where both plans are moving down to the high 5.8, 5.9 rates.
Oh,
Yeah.
and so the margin for adverse deviation payment is different from what we put in the section 115?
Well, this is OPEB. So you have two margin for adverse deviation
Deviations.
payments that are happening, one for pension going into your 115 trust
Okay.
and one for
Got
OPEB. Same concept, two funds.
So we actually have two 115 trusts, right?
Essentially, yes. Our OPEB SERP account is the equivalent of a 115 trust. It's just both.
But CalPERS managed the CERB account, is that right?
Correct.
Okay.
But it is a city-specific account.
So, I mean, I'm looking at this slide, we never had a policy like we paid 15 million in 2019 to just keep a flat payment and pay 15 million, even though the number went down. We're calculating it differently, right?
That's correct. Because we have risk mitigating strategies that Matt went over on that prior slide.
Yeah.
And so what that's done, to actually your point, Chair Du Bois, is it's basically kept our payment flat. So we haven't taken it down based on, like you see here, the normal cost dropping by about $4 million. We haven't reduced our payment by $4 million. We've basically stayed flat. And the reason we've stayed flat is those mitigating risk strategies. So that additional payment for adverse deviation, we did some additional funding because of the headcount that we added. You know, if the committee recalls, these reports are done every 2 years. So if we're adding headcount today, we won't realize the cost of those for 2 to 4 years from a reporting standpoint. So we didn't want to get behind. So we are proactively dealing with, you know, the headcount as we're adding them today. And
That's
so
what the 400,000 was.
Yep. Since most actuary reports are obviously 1 to 2 years in arrears, since they're based on the past, the staff, based on the council's direction with the pension funding policy of basically, please don't dig a greater hole than we are in, have made sure that as part of the council's budget actions, we are doing our best to stay up with the kind of business of the organization.
Thanks.
Thanks. Okay, so on slide number 6, we have your entire history here going back to March of 2008, where you sent us over $32 million to get things started. And since that time through the 14th of September 2022, at the time we created and submitted this report for tonight's meeting, you added an additional 52 million, almost 7 million. You've taken just a little bit of money out. That was an administrative matter that occurred in the around the 17, 18, 19 fiscal years. But other than that, you haven't taken anything out, and that was the plan. We have charged you a grand total of $1,116,553. And we've done okay by you. We've returned about 63.3 million. Which at that time brought your assets to 145 million and change. And the annualized rate of return net of all fees was 5.65%. I know things are wild right now, so I wanted to update you as of the 17th of October, so market close yesterday, you have 134,863,171. That same annualized rate of return is 4.85%. If we go to the next slide. What you can see here in the most important column to start with is the contributions column. The second column from the left is what you've sent into the trust each year. So one of the things that we might have said a couple slides ago when talking about the valuation is your retiree premium payments, they count annually as plan contributions. They're just not trust contributions because they're made directly from your general fund to the premium provider, in this case, the CalPERS PEMCA program as an example. And so the net difference between that and the amount recommended by your actuary plus the margins are what are actually going in the trust fund. So column 2 titled contributions actually illustrates that amount going into the trust fund each year. The other 2 columns, which are important, are the ones on the far right. And what they help us see is that each 365-day period can be quite volatile. And sometimes that's a good kind of volatility that you really like, and sometimes it's not. And what happens in the far right column is when you accumulate that and you average it over the inception to date period, the longer terms, you revert to the mean. So more on that in a little bit. Let's go to slide 8 unless there's questions. The main goal for the city is to improve funded status and continue to increase it till you get to the point where you're at some policy-based level or you're at some saturation point where it's unlikely that you'll have to add much principal other than normal costs to the trust assets in the future. And you start to actually subsidize your costs each year by reimbursing additional assets from the trust that are determined unnecessary to continue to maintain that fully funded status. And so you're on your way towards that, but you're not there yet. But at 67% as of 2021, it's great. The bad news is that you've probably dropped somewhat in that, and it's hard to determine what that would be at this time, but it's a good question for your actuary who can provide you an updated liability data set, and we can compare that to SERPed assets as of any date you'd like. So we can do that in the future. If we go to slide 9, wanted to talk about a little bit of the difference moving forward over the next 20 years as compared to our prior capital market assumptions. So you can see I bolded the row titled projected compound return 1 to 20 years. And the reason for that is because that's probably the starting point for discount rate determination by actuaries. So if you were using, a 5.75, that was probably getting ahead of the curve, because they probably will not use anything as high as these numbers. The reason for that is these numbers basically are assumptions that you would be fully funded, exposed to the asset allocation and earning those rates of return. But it's not quite how you flow cash in and out of a trust fund of this nature. You incrementally add money each budget cycle and the assets grow. And at a certain point, it would be more legitimate to use those full numbers, but probably not now. So this could mean a lowering of a discount rate choice or recommendation by your actuaries in the future. And I'll show you more on that in the next slide. If we go to slide 10, it's a little small and I apologize, but at the very bottom, that 6% number for SERP strategy 1, that's the 2022 number. In 2018, that same number was 7.59%. So that's 159 basis point reduction. And that also came along with an increase in risk, which I title in the very bottom row, standard deviation, from 11.83 to 12.1. So it's just more difficult to get the same type of returns as prior, with a, kind of a risk equivalent comparison. So that's the world we're in today. Next slide, please. These are time-weighted returns for our portfolio. I've already shown you the money-weighted returns based on your assets using portfolio number 1. We call that SERP strategy 1. What we wanted to show you here is that basically over the long term, when you look at the time periods compared to benchmarks, we have a really consistently low tracking error performance. And it's one that we think has been decent for the city. We'd like to see it better. It's been a very difficult period since January of 2022. Next slide, please. One of the strengths of our program is in our low costs. We are not for profit. The way we charge you is through a fee rate, which is all inclusive. So it just rolls in all costs of doing business. And this trust fund is self-funded, meaning that the participating employers pay the costs. So again, this combines administrative, custodial, and investment fees. And that fee is applied daily to your assets under management. For our OPEB trust, you can see there it's 10 basis points. So it'd be about $1,000 on $1 million invested over the course of a year if your balance didn't change from one day to the next. Very generic way of expressing it, but sometimes that helps folks. If we go to the next slide, you can see our history with setting the fee rate from one year to the next. It's very consistent. So I think that's 8 or 9 years there. I'm not sure where we've been at 10 basis points. For the future, the projections appear to be a steady hold at 10. And if we were going to go in any direction, it would probably be a reduction to 9 as opposed to an increase to 11. But that's just forecasting today. So the good news is that the same total participation, cost fee rate that's always been low is going to continue to be that way for some time based on our projections. Next slide, please. In wrapping this, just wanted to remind you of who we work with. There's a lot of agencies up and down the state, but there's 156 other cities or towns in California, just like the city of Palo Alto, who we're doing this work on behalf of. And it's about 600 or so clients. So we're really honored to be able to continue to serve you in this space. And thank you very much for your time. I'll open it up to any questions.
Lydia or Eric, do you have questions?
I don't have any questions.
I'll jump in with a couple real quick. I don't hear any. That 1 year that we did $1 into OPEB, I don't recall that. Why did we do that?
It was an administrative error. If you look at the next year, you'll see that it's double what it was annually.
Okay.
We just missed the cutoff date. So.
Slide 7, if you could put it up, it's easy to see. And
that's fine. I got it. I thought that's what it was, but I didn't remember. Yep. And how is OPEB paid? Is there an employee contribution, or the city's contribution? Where does that come from?
It's part of the retiree benefits. Matt, do you want to explain the details?
Yeah, so it's unlike pension where there's a member contribution and that's made by the actively employed person when they're working. And then the employer is required to make a contribution as well. Those two contributions are principal that go to CalPERS, and then that principal gets invested. In OPEB, what you're pre-funding is the employer's liability, their benefit promise. So if the premium is $1,000 a month and they promise to pay 800, then the 800 is used to calculate your liability, not the 1,000. So it's the city who makes those contributions to the trust to pre-fund their own benefit promises, the portion of the premiums they choose to subsidize. Does that answer your question?
So when the retiree has to pay a monthly fee?
Yeah, that's not required. That does happen with employers. We refer to that as cost sharing. It's not identical to the type of cost sharing that's done in the pension space. It's usually cemented through a memorandum of understanding where active employees, let's say like myself at the state who is doing this, we would from our paycheck pre-tax contribute some amount that was negotiated to maintain benefit levels at a price point over a period of time.
Right.
And we're doing that at the state. It's about 3% of pay every month.
Yeah, so I was just trying to understand with City of Palo Alto, is it currently just funded entirely by the city?
That is my understanding, but I would want to lean to.
Yes, we also have multiple retiree health benefit levels. So similar to pension, where the city had what was with CalPERS, but then chose to implement a lower benefit level. So we call them tier 2 or new classics, basically. The city has amended our retiree medical program a few times. So each program's a little bit different. But to what Matt said, the city is funding the city side of the contributions of those programs. And if there's an employee side, let's say I'm making this up, but let's just say like Matt said, it's an 80-20 split for $1,000 premium. The city's contributing 800, and then the retiree would be contributing 200, almost like you do as a full-time employee, but in retirement.
Yeah, but what is the actual strategy in retirement? Is it covered by the city or does the employee pay?
It depends on the plan.
Okay.
Yeah,
And
it
then
depends on the plan.
my last question. So we're in this strategy 1. Is that seems to be the most aggressive investment strategy?
Yes, it is. Can we go please to slide number 9? This will be more helpful. So strategy 1 is our most aggressive strategy. You might characterize it as moderately aggressive. It just, might depend who you ask to characterize, but you can see that to the right of strategy 1, both strategies 2 and 3 are more conservative. And the way that actually is manifested, if we go to slide 10, is through differing levels of exposure to the same asset classes. So you can see that what we do is we taper down the exposure to global equity as we go across from strategies 1 to 3. And then what you do to backfill that and replace it is you increase the exposure to fixed income. There are some changes to the REIT exposure level and to the TIPS exposure level, but not nearly as significant as the relationship between equity and fixed income.
Yeah, so it'd be interesting as we look at the pension investment strategy to compare these two.
A couple of things that I have shared with staff and I don't want to get ahead of them, but just you can utilize more than one strategy, 2 strategies simultaneously if you chose to do that. So that is something that you all might be discussing, and I'll leave it there. Or you can move to another strategy at any time should you wish to do that. And both of those options would come with no costs, no additional fees moving forward.
So
Sure, and just to pick up Chair Du Bois and Matt, as you've referenced, staff has highlighted that in the staff report. I'm looking for the packet page. OPEB contribution. I think investment overview and options. So packet page 9. And moving to packet page 10. So, one of the items for the committee tonight, and this goes for whether it's the SERPT trust, so the OPEB trust or the pension trust. We started these trusts with small amounts of funding with the goal to accumulate and grow our assets to offset our liabilities. Once we had a long way to go. Not saying that we're there, but we are a marked change in our positioning today in terms of our assets versus our liabilities compared to where we were when we were establishing these. The 115 for OPEB, obviously in 2008, our 115 for pension in 2017. And so one of the things that staff kind of highlighted and Matt's alluding to is starting to contemplate what's next. We're not there, but we weren't there when we started these trust funds. But we are looking at, in the coming short term, probably 5 years or so, reaching levels where we likely are needing to make some changes because we're becoming more sophisticated in the assets that we have. So, for example, on SERP, what Matt is alluding to is once we reach a certain level of assets, we're going to move from a position of perhaps wanting to aggressively grow those assets to offset our growing liabilities to a mode of preserving assets and using some of those assets to pay our costs. And so when you move from a growth strategy, which is where we're at today, to wanting to either use the funds to start paying liabilities or a preserving strategy because you've hit the asset level that you're seeking, we're going to want to look at different investment strategies that align with that. And it's not a one size fits all, as Matt said. And this goes for our pension as well. So again, these same for pension as it is for OPEB, but we do need to start thinking about the use of our trust funds. Are we anticipating drawing funds from them in the near term, meaning 1 to 5 years? If so, maybe we need to diversify so that we're not pulling out when the market is low, and mitigate some of that risk by investing in multiple strategies. So again, this is why we have our experts here tonight to help you think through some of these things. Like, why would you want to invest in different strategies? When do you pull the trigger to start diversifying and investing in different strategies? And what are our options? Because these are the things that staff is working on for your consideration by the end of this calendar year as policy calls to include in the pension funding, and I guess we should probably expand the name, in our long-term liability funding policy as we reach these goals. I very much expect if we come back every 3 to 4 years to have this kind of in-depth sync on where we're at in reaching these goals. I very much expect us, barring a significant recession, I very much expect us to, during that period of time, be seeking to change and diversify our investments, at least in OPEB. Because if, in theory, assets grow sufficiently without a recession, we will move into an ability to pull funds out of our SERPT account to pay for some of our PAYGO costs, which means you don't want to have a 12% annual risk because you might be pulling it out at a 10% loss. And so you'll want to diversify your holdings, basically, for the intended uses of funds. So just throwing that out there as we are embarking on that kind of next phase of what do we do with these trusts and how do we manage our liabilities and, at this point, assets once you get to a point where you're not only seeking growth. Hopefully that's helpful context.
Okay. So Eric, Lydia, do you guys have questions?
I'll take a couple. I wanted to ask a question about packet page 9. which I sort of did the double check the first time I read it, but I think I read it wrong, where we say City Strategy 1 Fund has experienced, quote, a cumulative net gain of 5.7% since its inception in 2007. What that means is, you know, that's the 5.65% per year, right? As opposed to we got 5.7% more today than we did in 2007. Okay, so so why then? I mean, it seems in retrospect, of course, hindsight 2020, it seems like we should have been calculating our normal costs all along at 5.65% as opposed to 6.75 or 6.25 and so forth. Is that a sensible way of thinking?
I don't think respectfully that actuaries would agree with that. There's probably two different sets of opinions, with actuaries being the longer term lens and investment folks being the shorter term lens. That might be a really truthful and more applicable statement if we're talking about a 10-year time horizon as compared to like a 30-year time horizon. So I would think that it depends who you ask. But in the context of OPEB in particular, it's a really long-term benefit. And you start pre-funding someone when they're actively employed at age, let's say 42, and you pay for their benefits until they die at age 82. You're talking about a 40-year time horizon. So I think it's probably more applicable to use those longer-term expected rates of return. But that said, you do have plan experience now from participating in the trust since 2008 that you could justifiably utilize in setting discount rates, and it could be very helpful. If you go to slide that I was showing, slide number, sorry, got to go back one, slide number 7. The purpose of me adding the column on the very far right of slide number 7 is to show you what happens with mean reversion over time. So if I was sitting in this room somewhere in the 2020-21 fiscal year and I showed you the 7.8, I guess my question back to you is, would you say the same thing, right? Now that may just be impossible to achieve moving forward. And I think it's probably true that it is. And I think it's probably true that something in the high 5s to 6% range is probably more appropriate moving forward. But it really just depends who you ask. So I do like the way you're thinking because of where you are moving and shifting probably more to a preservationist mindset because you work so hard to build up all those assets. And I think the actuaries would probably agree, in particular, based on what capital market assumptions are today. Does that shed some light on it in a way that's helpful to you?
I think
there's a lot of words.
I think the answer I heard was yes. Okay.
I'm very good at the long-winded version of that. My apologies.
So.
Well, and I think Councilmember Phil said, right, what you're hitting on is what we've chosen as an organization with the council's leadership of,
right.
Do we really assume those higher rates? And we've chosen not to, which is why on the OPEB side, we've not only chosen a lower rate, but we've also chosen a shorter amortization period.
So, okay. So I think it would be helpful for layman types like us on city council. Okay. To understand to keep track of the actuarially determined normal cost plus the MAD, that number would be of interest in tracking, right? And what percent expected asset return rate that represented.
I think that's totally fair.
Okay. I think, yeah. Well, I got sort of a question. I've, all these last years, I've shied away from the issue of trying to dive into the portfolio management side of this, but I'm going to have a couple of questions about that when we get to pension for the first time. So, I mean, I think just in general, yeah, as we think through this in the next 5 years and so forth, I continue to think that it kind of makes sense to, at least one way to think about this is as of two buckets. Okay. One is our existing liabilities, in which our assets and our liabilities don't match, right? And the other is liabilities we're putting on right now. And so when we make so Steve Gugliardo just came back to work for us. And very happy to see that. So when we contribute the normal cost of Steve Gugliardo's pension, I mean, hopefully he's not going to retire for another 30 years. Okay. And so to that one, it seems like, you know, we're probably better off not worrying about short-term cash flow, as long as we got that separate, okay, from the other stuff, because we're going to have to pay, you know, Dennis Burns's pension, you know, some more next year too, right? But as long as we keep that stuff separate from this, then we can afford to take a very long-term view on how we invest the normal cost components of these things. And that means that, you know, maybe we don't have to invest, you know, 60% in fixed income and so forth, right? If we can keep those separate, right, then that makes it simpler, at least for me, to think about it, right, in terms of, you know, what kind of investments we make. Now, that just shifts the problem on how do we pay for Dennis Burns's pension next year. Okay, so I get that, okay, but at least we've broken down the problem into, you know, some chunks we can manage.
So I was thinking about it differently. I want to see if I'm thinking about it right. I thought we were thinking about it in terms of how much funded the account is. And when we talk about a blended strategy, are we really kind of creating like a target year fund approach where we're saying we're going to have a mix of aggressive and shift to preservation because we think we're going to hit the 80% funded level in this year? You know, is that more of what we're talking about? As we shift our strategy, like once we're funded, we're not really thinking about the individual employees. We have a portfolio of ages of employees, and we're just trying to preserve being funded at that level. Is that right?
When I presented this idea to, you know, Kylie and the team, Jesse and the team, what I was thinking is, at what point are they going to start reimbursing from the trust? And let's say that they wanted to do that at a time like now. It would be better to be pulling those assets, arguably, from strategy 3, where the projected volatility is 8.4, and the probable real volatility that you experience is less. And it really depends, because right now, for the 2022 calendar year, it's been both stocks and bonds that were culprits, and you know, there was really not a lot of places to hide. But nonetheless, let's just say moving forward in 5 years down the road, stocks are the culprit. It would be better to reimburse that money from strategy 3 as opposed to cementing unrealized losses out of strategy 1. So if you just placed a little bit of money, maybe a year or two of reimbursable assets into strategy 3, you wouldn't have a lot of drag on total performance. But at the same time, you would have much more functional liquidity. So it was just a way to try to be able to navigate, how do I use trust assets during difficult time periods in the event I needed to do that without having a lot of drag on my portfolio's performance at the same time. I don't think it's a perfect science, but I don't know if it turns it into target date funds either. It's an interesting way to look at it. I hadn't thought of it in that way, but I do see why you would look at it that way. I'd have to think about that a little bit, but that was why I presented the idea. Is how do we make this product more effective for the clients? And through flexibility and being able to use multiple strategies, and just not 3, but 2, you know, at the same time, that might meet your needs even better than just using 1.
Although, you know, we run into some complexity because of, you know, different time frames to the time we're going to have to pay stuff and so forth. But the way I have thought of the Section 115, at least for the pension, not for OPEB, right, you know, has been You know, the money in the 115 for pension is normal cost money, okay? It's the difference between what CalPERS tells us the normal costs are and what the normal costs really are, okay? And so the money in the 115 is committed. I mean, it's committed to paying the normal costs, you know, the future pensions of the people whose normal cost contribution it went towards. And so why would you ever want to pull money out of the 115 to pay down the UAL? It seems like we got to treat the UAL separately. We got to figure out how we're going to pay off the UAL, okay? But we shouldn't rob the normal cost bucket for which is nominally fully funded now, okay, at least from the time we started, you know, to mix it up with the UAL. So that's what makes me uncomfortable, that kind of stuff. Now, to your point, you know, the age to when we're going to have to start paying money out to the people that are covered under the Section 115 with the normal costs, you know, some people are 2 years from retirement, some people are 30 years from retirement. So we probably ought to think about that, right? It's probably not quite as simple as I sort of made it out to be. But my initial reaction to the idea of pulling money out of the 115, for example, to pay down the UAL, is one of trepidation, because I think it makes it harder for us to manage, you know, the circumstance we're in. I mean, the inviolable law we must not break, okay, is we must not dig the hole any deeper than it already is, okay? And games with normal costs and UALs and, you know, funny discount rates and so forth are how the whole state got where it is today, and we need to stay away from that.
Should we move on to pension?
I was gonna say, we've kind of
Osmosing in there, aren't we?
Yeah, well, so I think that's great, Chair, and thank you, Matt. And Matt, please stick around. I suspect we'll have more questions throughout the evening.
Yeah, I'll definitely do that. Thanks.
Thank you. So Jesse, I'll turn it back to you to introduce our PARS team.
So the next presentation will be by PARS, and I believe Mitch Parker, is that you? Okay.
Thank you, Mr. Chair, members of the committee. Glad to be here. It's fun to get out again and see folks in person. Drove from Central California to get here and enjoyed every bit of it, despite the traffic. Okay. Joining me is obviously Andrew Brown here, portfolio manager for your agency. Just a reminder, we have 3 companies working together to bring you this program. PARS, we're the trust administrators. US Bank is the trustee. So they hold the assets, and Highmark Capital is the investment management partner. Next. This is a IRS approved trust. Is capable of pre-funding OPEB or pension, and you're using the pension bucket. You have $39.3 million in assets to date. A reminder, the money can only be used for pension-related expenses, and you can do that in one of 2 ways, either to reimburse the agency for pension cost, or you can pay CalPERS when you deem it appropriate. Next. Next. All right. Historically, let's just bring things up to date. So it began 2017. The investment strategy is moderately conservative. It is an index platform, so it's using index or exchange traded funds. Initial contribution back in May 2017, about 2 million. Additional contributions, a little over 36 million. So 38.3 million to date as of August 31. There's been 1.4 million in investment earnings. So the account balance to date is 39.3 million. Next. We also give a graphical representation over time, so you can see what the inflows of money have been per fiscal year. And there's been no disbursements to date. Next. Here are the latest numbers from CalPERS that we can see on the website. We've got 2 fiscal years, including the most recent available. Actuarial liability, 1.4 billion. That went up about 4.9%. Assets are at a little over. Oh, we've got an M down there. That should be a B for billion. So 21% return from their very good performance a year ago. So the good news is the unfunded liability went from 510 million down to 391 million. So a 23% decrease. And conversely, the funded ratio went from 63.5 to 73.3. Matt, I feel like you should be given these numbers, but the employer contribution amount went up from 55 to 60.4 million. So those are the numbers to date. Obviously, this doesn't value in what just happened, which was the negative 6% return. We'll wait to get those 1 year from now.
Well, and we roughly know, as we talked in our last meeting, that when you factor those in, you're looking at about a 10% decrease in your funded status. So if you were at 80 as of this actuarial report, next round, give them the 6% decrease, you'll be at 70.
All right, turn it over to Andrew to get into the specifics on the investment side.
Yes, good evening, everybody. My name is Andrew Brown, Portfolio Manager with Highmark Capital Management. Outline for tonight's presentation, I'm going to start off with just maybe a 2-minute thumbnail sketch on the economic forecast. And then I'm going to hit on the performance. And I was going to focus on the last 12 months, but since me and my team have been the portfolio manager since day one, we'll be happy to address any time segment you want to reference. And then share with you a little bit about the positioning for the pension plan as of a most recent quarter end. And then hopefully maybe all that dovetails into a real thoughtful discussion in terms of future positioning for the plan assets. And so next slide, or maybe 2 slides, yeah. Okay, well, it's been a humble experience investing in these capital markets, not to mention trying to provide an economic forecast. You know, we have the middle column there shows our 2022 end of the year economic forecast. And you know what? It seems like every year or every month we've revised in some way, shape, or form our economic forecast. So we're going to probably nail it mid-December. Probably more insightful to take a look at 2023. And I'll share with you this. In the upper left-hand corner, you'll see September 2022 Highmark Asset Allocation Committee. That's the last time we met. We meet tomorrow, and I can give you a preview of our revised 2023 economic assumptions. And just very quickly, GDP we see between 0 and minus 0.5%. So we see a very light recession, year-over-year GDP decline for next year. In a small recession, we would expect to see corporate earnings go down. Right now, we're at $205 per share for S&P 500 earnings. Unemployment, we see it ticking up a little bit, 4.2 to 4.7% for next calendar year, at the end of the year, I should say. Core PCE, 2.5 to 3%. So, you know, I think probably our biggest sin this year was joining the transitory inflationary camp. Inflation was anything but transitory, but I think well, we're sticking to our guns in terms of inflation rolling over next year. We have it now 2.5 to 3% at the end of the calendar year. And then Fed funds, the end of the year forecast was 3.5 to 4%. We have taken that up to 4 to 4.5%. So right now, the Fed funds target is between 3 and 3.25. So the Fed has more work ahead of it, at least from where we stand. So interest rates will continue to head up. And most of that really might happen in this calendar year before the year's out. Upcoming meeting in November, we very well could see 75 basis points, and then maybe 50 in the month of December. So yeah, obviously I present these numbers quite humbled. Because we certainly shot an air ball in 2022, and our forecast for 2023 is a slight recession. Next page, please. This is the performance template that we provide to staff on a quarterly basis. For maybe those who have not seen this setup, this template, the column periods are time segments. So we have the quarter, year to date, 1, 3, 5, and then inception to date periods of time going from left to right. The black colored font would represent segment returns for the plan. And then maybe the lighter brown colored font would be some type of representative benchmark. Since this is an underlying index-based strategy, we wouldn't expect to see too much deviation between our return and the underlying benchmark. And then where we do, I hopefully will have a good explanation for it. The last 12 months, and this is through end of September calendar or September period, the performance is the third column over from the left. And so the 1-year column, starting off with the good news, and the only good news I really have is our cash money market with the Fed raising rates 300 basis points this year. We finally have a little bit to show for cash returns. We generated a 0.45% rate of return over the last 12 months, the bulk of it really coming in the last quarter. Currently, our money market yields about 2.1%. So 0.45% run rate for the last 12 months. Fixed income, minus 13.18%. Total return for the last 12 months, put that up against the Bloomberg US aggregate benchmark index of minus 14.6%. I'll say, I won't call it outperformance, but it's a little bit less worse than the benchmark. We have a shorter duration positioning in a Vanguard fund that has cushioned the blow a little bit, but the minus 13.1%, I mean, it's been a very, very tough 12 months, and really it's been a difficult last 9 months. We have 5 investment objectives that we offer our PARS clientele. And I'll share with you this, is that the hardest meetings that Mitch and I have are when we go in front of the conservative clients who, not conservative from a qualitative standpoint, but who have selected the conservative investment mandate, which is maxes out equities at 20%, fixed income is 80 to 95%. Or tonight, a moderately conservative portfolio where it's 50 to 80% bonds, 20 to 40% stocks, because conservative, moderately conservative, if you have more than half of your assets in fixed income, you typically think that, well, that's going to preserve and protect. And yeah, I might see a negative return over a 12-month period of time, but you don't expect a minus 13.18% from your fixed income over that period of time. So these are, from a client servicing standpoint, some of the more difficult meetings that I have and Mitch and I have together. The equity is at minus 19.2%. I know minus 19.2% is worse than minus 13.1%, but stocks going down, 20%, it does happen about once every 6 years. So it's not a 100-year flood sort of thing. You got to go back to the 70s or maybe even before the 70s to find a 13% decline in a 12-month period of time for fixed income. So, not to beat a dead horse, but the equities, the bonds, it's been a very rough 12 months. And diversification, I've heard that mentioned a little bit, before we presented tonight, hasn't really helped you on the equity side this year. I mean, large cap minus 15.4, mid cap minus 19.3, small cap minus 23.5. Either developed or emerging markets for international equities, minus 25.1 for the developed markets, minus 28.1 for emerging markets, and then REITs minus 17.6 for that benchmark. Put it all together, it's a minus 14.29% gross of investment fee rate of return. That $40 million portfolio, I believe, our investment fees would be right around 20, maybe 21 basis points. So if you were to net it out, it'd be right around minus 14% for the last 12 months rate of return. Do you want to ask questions now on the performance, or should I hit the positioning? Okay.
Yeah.
We all saw this.
Yeah. Let's talk about positioning then. I referenced it as we call it moderately conservative, and that's really just an asset allocation policy where the equities, which are represented at the top of this page, range between 20 and 40%, strategic ranges, fixed income, as I mentioned, 50 to 80%, and cash money market ranges between 0 and 20%. The current tactical policy is depicted on the second column over from the left. Equity is currently at 27%, fixed income at 67%, and cash money market would be at 6%. No no brownie points for being underweight equities over this period of time, given the just terribly disappointing investment returns for fixed income. We do have, I would point out that the 6% in cash, that's, I've been the point person on the PARS portfolios going back to about 2003. And really, I think that this is the highest that we as a firm have positioned cash over this period of time. Usually we have about 1 or 2%. So 6% is a fairly large allocation just based on historical positioning. And yeah, 27 stocks, 67 bonds, and 6% cash is our allocation. Next page, please. And then just finally, these are the underlying index returns for the investments that we are invested in currently over quarter, year to date, 1, 3, 5, and then 10-year periods of time. The 10-year period of time obviously captures longer horizons than we have worked together, but that's the returns for the individual investments. And then I did include a page, one next page, and in hindsight, it's maybe it was it's wise to include this. Not that I necessarily came to tonight's meeting suggesting that we should change the investment objective, but it is a discussion point that Mitch and I are having with our clients. And so to the extent that we want to maybe broach it, not necessarily for the near term, or we can for the near term, but maybe, as Kylie mentioned, 1 to 5 years down the road, although I think she was referencing OPEB, these are the 5 strategies that we offer our clientele. So if you're looking at the exhibit, the efficient frontiers, you go from the bottom left to the outer right. As you go from the bottom left to the outer right, you go from more conservative investment objectives to more aggressive. Obviously, the differentiating factor is you replace fixed income with equities as you go from the bottom left to the outer right. Right now, you are in the second most conservative investment strategy, moderately conservative, depicted there, second up from just conservative, or you can also see the table insert with the corresponding asset allocation, strategic asset allocation policies for potential consideration. Although, like I said, I did not come into tonight's meeting thinking I would make any recommendation to change, but love to talk about that as well as any other questions you have.
Okay, thanks. This was actually the chart that I was going to come to. Right. So this is a helpful way of visualizing this, of course, especially for sort of, our specific, eccentric view of all this. We are ultra hawkish on normal costs. And I think this is less than an issue because the section 115, it's $40 million in it right now. And, it's a pretty tiny fraction of sort of our net pension assets, most of which are, not invested as conservatively as this. But it is growing. And if the expected return of the moderately conservative, I don't know, it's 4% or something like that, or 3% or something like that.
Well, if we were talking OPEB 30-year horizon, we would say 5.5.
5.5 for the moderately conservative?
For moderately conservative.
No, I thought I read quite a bit lower. Okay. So yeah, so that was my question was, we better make sure that our expected return on our portfolios is the same asset return rate we're assuming in calculating our normal costs. And so if we're calculating normal costs using a higher expected return rate than our moderately conservative portfolio, then maybe we ought to change portfolios or else recalculate our normal costs, right? So those should match. And that was really my question and concern here.
And so before addressing that, let me throw out time horizon, because time horizon is important. Clients hire us typically for 1 or 2 reasons. I mean, pension rate stabilization, that's sort of the truncated, that's a long version of the truncated PRSP. And so from that, they're saying, okay, well, pension expenses going up. we look at our fiscal year 25, 26, and we got a donut hole in our budget. We don't know how we're going to plug it. We got a couple million now, so we're going to give it to you, and you're going to manage it in some type of allocation. But eventually, probably in fiscal year 25, 26, we're going to take it and give it back to Matt. And so that's one reason. And then another is how staff described it in the report. You want to get to 90%. And so this is a pool of funds that augments that effort to build the asset pool to get to 90%, while giving you the budget flexibility that if you did have an unforeseen circumstance in your budget, you could reimburse yourself for pension costs, i.e. hand it over to Matt. But it sounds like you're the latter. I mean, you're focused on the 90%. Would that be a fair statement to make?
I'm not sure we've thought through that quite in those terms as a group, right? I think, there's one bucket we want to be at 100%, right? And then there's another bucket we're going to try to pay off, at some rate that we're still talking about, and the aggregate of that is maybe it's 90%. Right? So, but I think that the 90% is sort of an output rather than an input, if that makes any sense. So you think so the 5.65 is for the moderately conservative? I thought that was 5.5. Yeah. Okay.
And what would the moderate be at in the long term?
Yes, Chair. So once again, these are 30-year horizons, so it's long term.
So I was looking at this one that said 4.1% here on page 7. Am I looking at the wrong column?
It's 10 years.
10 years. Okay, so your longer than 10 years is 5.5%.
Right. Yeah. So to answer your question,
10
Chair,
years might go back to the 70s, right?
So what?
Long year, that might go back to the 70s, right? 18% mortgages and so forth.
I want to say we're headed there, but we do have a 7 handle now. 5.9%, Mr. Chair, for moderate.
In the 30-year time frame?
Yep.
So it's the same as the 10-year?
No, well, what?
Say that one more time.
Yeah, well,
Chair?
what page? You said the 10.
I'm looking at page 7. It says
On
the
packet page
10-year.
7. 10 years,
return.
4.1%.
Yeah, 5.9% in 10 years.
That's sweet. Jesse took that. Yeah, and so Jesse points out that what staff has done is taken historical returns, and I believe that is represented by that 10-year, the 10-year historical look back.
I see. Okay.
Which has embraced one of the largest bull markets in the equity market going, despite the miserable last 12 months. So ours are more forward projections.
Got it.
When I say 5.9 for moderate and 5.5 for moderately conservative.
Yeah, I guess one way I've been thinking about this.
Do you think 5.5% is realistic for moderately conservative for a portfolio that's 3/4 or two-thirds fixed income?
This is good that we're in person and not on Zoom, so I can look you in the eye, and like when kids lie, they look to their left and it's all that stuff.
I mean, we want to know what it really is. I mean, we're agnostic as to whether it's too high or too low and so forth. Okay, because we'll adjust our normal costs and our budgeting to factor for it, right? But we want to know what it really is.
So all of the things that Matt said earlier, I totally agree with. And if I was filling out a blue book, I could put that into the blue book and submit it to the professor. But I'll say this is that we do our capital market assumptions on an annual basis. And we do that exercise. We started in February and we usually finish it up March, April, if we're busy with other things. And if nothing different happens between now and next February, which, yeah, fat chance. But interest rates are headed up. And so to the extent that really what has been kind of damping down our capital market assumptions over the last 3, 4, 5, 6 years, it's been fixed income. That's been the thing where I would go, Yeah, Eric, I think we can get that. I've been looking away because fixed income, I mean, what were we looking at for a 10-year treasury, a couple of years ago? 1.5. Now we're looking at fixed income with a yield curve that actually can generate a four handle with relatively easy ease. And yeah, I know it's a 30-year horizon and it's not a 10-year horizon, but fixed income with 67, 50 to 80% of your portfolio assets in fixed income, where at least today we're at a four handle across most of that curve. It makes it much, I don't say easier, but much more realistic. I mean, our numbers, CalPERS numbers, it is a guess. I mean, we are giving out a guess. Hopefully it's an educated guess on both of our parts, but it's a forecast guess. But I think it's much more doable, a 5.5, when I'm looking at a four handle on mini bond.
Because you think that the risk-free rate is going to rise and stay at 3% or something like that, as opposed to where it's been.
I don't think we would say 3%, but rise and will be higher than it has been the last, wow, 10 years. Well, before 2022, let's say that.
And that'll, but then, okay.
So,
But then all our liabilities are going to go up by that much too, because they're all tied to inflation.
Inflation has many factors, and that is something to consider. Yeah.
Yep. That's our problem, not yours. Okay.
If it's your problem, it's my problem.
Chair Du Bois.
yeah, no, I guess my thought about this was because we are less funded in the pension fund, that we should perhaps consider a more aggressive investment strategy and moving up to moderate. It's a much different situation than where we are with the OPEB fund.
Yeah, that was kind of my thought too. At the same time, I mean, at some level, we're talking about the section 115. It's a pretty small portion of our assets in this. So, whether it makes 5.9% or 5.5%, it doesn't make that much difference in the grand scheme of things, but we ought to pay attention to it.
That and I also think what Matt pointed out about volatility, now granted that was his presentation, but I think his points were solid in terms of considering the volatility within OPEB and also considering the volatility here. I totally echo your thoughts, Eric, about 5.5 to 5.9. Yeah, 40 basis points over a 30-year horizon compounds and it makes a difference. But yeah, markets rebounding, we're gonna get a good bang for our buck more than likely on fixed income, and having a 50 to 80% on fixed income that rallies a little bit. I mean, it's not going to be like that stock market pop, but you know what? Like I said, I came in here to offer up staying the course would be my first recommendation, and moderate, you don't get much bang for your buck, I don't believe. So I would say stay the course, moderately conservative.
And this is Mitch talking, right?
This is Andrew Brown.
Oh,
Portfolio
Andrew,
manager.
sorry. So Andrew, I guess, this money, again, it's in the pension. How much do you think we should look at comparing this to CalPERS performance with the money that we give them?
Yeah, there's a lot of our clients that like to do that comparison. I think it was easier to do that comparison, maybe 8-9 years ago. I don't remember, Matt, when you changed your strategic ranges, and now you have more in real estate, at least I think over the last 12-18 months. And so it makes it a bit more difficult to do an apples to apples comparison. And I don't mean to be dodging the question. I just, as they bake their cake one way and we bake ours our way, it's a little bit different. It can both be delicious, tasty cakes, but they're just.
I mean, this money is ultimately going to pay down that unfunded liability. If we put it in our own fund, we're following slightly behind versus whether we had just given it to CalPERS. But I guess in exchange for that, we get flexibility.
If I may, regarding, do you mind if I may? Regarding CalPERS at negative, 6.1% for the last year, right, ending June 30th, compared to CalSTRS, something in the negative 1%. So two funds kind of doing something really similar. Why was there such a dramatic difference? It's private assets. So I think, Mitch and Andrew, that, and I know nothing that I showed for SERPed investments includes any private assets. And I think the same can be said for your portfolios. So what helped CalPERS not be so bad was the private assets they held, and they have a policy to increase that moving forward. What helped CalSTRS be even better than CalPERS is they already have even more private assets in their portfolio. So within the public asset spectrum, there wasn't really any good place to hide, as Andrew eloquently illustrated and talked about. So I don't know if a comparison is possible, Mr. Dubois. I don't think it is. It wouldn't be fair in my mind to compare the moderately conservative to the CalPERS portfolio expectations. You're asking way too much of moderately conservative. I mean, that's not what it's designed to do. It doesn't have the same
Right.
horsepower.
No, I'm really like talking about our policy for this money that we're putting into this trust. I mean, most of our city investments are very conservative, but should we be more aggressive in this fund?
Yeah, I don't think Tom was sort of praising or burying CalPERS portfolio performance. I think the more deeper question is, where for this asset, where do we want to be on this curve? Okay, and the observation is, well, we think CalPERS, our CalPERS portfolios out here and our Highland portfolios over here, and does that really make sense? I mean, that's kind of the question I think that we're asking, and as a municipality, obviously we have sort of all kinds of money and assets lying around and so forth, and some of them need to be very, very conservative, right? Because the nature is we might need to use it next year, right? Here we're talking about, at least for some of it, we're talking about very, very long-term kind of holdings. I mean, Steve Gugliardo's the normal cost we pay on Steve Gugliardo's pension this year. I mean, we're going to hang on to this for 30 years, right? So I think that's sort of the question we're trying to tease out is, are we in the right place with the 115, and then sanity check, are we in the right place for the majority of it with Matt, right? So I think that's sort of what we're sort of trying to scratch our heads a bit on.
And Councilmember Philsip and Chair Du Bois, I think the question gets back to actually how Andrew started with the two primary functions that cities use their 115 for. One being a rate stabilization fund, and the other one working to build their asset pool to meet a funded status. One would argue one investment strategy. The other one would argue the opposite. If you're using this fund for rate stabilization, you want that money there when you need it. So that's going to beg one investment strategy. If you're using it for building your asset pool, you're going to want to put it in a different strategy because you're not necessarily trying to use it. Now, it's not a 1-for-1. That's why you have 5 choices. But I do think the policy question that's before this committee, as we review the policy itself, is honing in on what we intend to use these trusts for. I think the city has done a good job of diversifying our options so that we have flexibility depending on the scenario that we're in, whether it be fiscal, whether it be liability, or something external, I don't know, pandemic that hits us. But, and so now I think we just are at a point as we're reviewing this policy to start thinking about being a little bit more intentional with these tools so we can sharpen the pencil on them and use them as effectively as possible.
Got it. That's actually very helpful. I think that's a very good way of looking at it. So thank you for that. I guess I guess I understand a little bit of what you were saying earlier about, we're going to reach a point where we sort of start to think about it maybe differently. I think up to this point, at least I anyway, have thought of this as, this is about building an asset base to where it needs to be, because we're so far underwater, right? That I think we had the eighth highest per capita pension liability in the state of California a couple of years ago, or something like that. So, I still continue to think, for the moment anyway, that our top priority ought to be building the asset, right, as opposed to rate stabilization. Maybe when we get to 90 or 95% funded, then we should think about that kind of stuff. But at the moment, I guess I would argue that life is full of variance, and if rates go up and rates go down, it's going to happen. The fact that we are saving more than the actuarially determined payment every year also gives us some cushion for rate stabilization issues, because even if Matt comes back and says, folks, the ADP has to go up 10% this year. Well, we're already saving beyond that. So we're somewhere, we just have less extra than we thought, right? Although,
but Eric, didn't we see, again, with that latest report, with this current year, we're actually falling behind again, right? It pretty much wiped out the gain we had.
Yeah, well, but if you take a long-term view, which as financial professionals we hate to do, right? But if you take a long-term view, you look at the big gain from net last year and go, well, maybe we got lucky, maybe we didn't. Okay, but reversion to mean, we can't really expect that. We can't really expect that we're going to have 7.8% returns, every year, just because we had one last year, right? And so, right. Some of the metrics that we use are interesting metrics, but what's the net present value of the future liability, and it bounces around all over the place with tiny assumptions about what your discount rate changes will be.
Yeah. But I guess
some of that's just noise, right? So
right. No, I hear what you're saying, but I definitely have felt like we're still in the playing catch up, building up the asset.
Absolutely.
Camp.
Absolutely. We have somewhere in the range of probably more, right?
Yeah.
$500 million of unfunded public pension liability.
But then what I heard Andrew say was, well, given what's happening with the markets now, he would not recommend going for the more aggressive strategy, that because we think, fixed bonds are going to start to
Right.
pay better, right?
Well, there's a good reason to think about that, and there's a bad reason to think about that. Okay, the bad reason is, holy Toledo, guess we were a lot more exposed to interest rates than we thought. Okay, let's go buy something different. That's the bad reason. The good reason is to look at our assets and our liabilities, our maturities, and when we're going to say, are we at the right place in general on this curve? And I don't think it's crucial that we make a decision like that this week or even this year, right? But that's sort of a longer term kind of thing, and 8% inflation or whatever it is this year, this too shall pass. But we do need to think about strategically where we want to be on this curve.
Right. And part and parcel of that is a question I asked you, but maybe I would put it to staff, and you don't have to answer tonight. But as you do this thought process, what's the probability that you're going to need these funds in 5 years, 7 years?
0.
I guess I can put it to staff and have it be 0.
I better ask the person whose job it is to do this.
Yeah, maybe.
I serve at the pleasure of the council. Well, I serve at the pleasure of the city manager, who serves at the pleasure of the council. But I think that's a fair question. This council has a history of strong fiduciary discipline. even in the pandemic, while we were going through significant economic impacts, the council held their ground with, as Councilmember Philseth said, don't dig that hole any deeper. And so we maintained our policies for proactive funding. So I will never say never, but I would say that
I shouldn't either, because, there will be a new council.
sure, yeah, there will be there. We are going through an election.
But if you don't cover
with
your
3
normal
council
costs,
member
you're
seats.
borrowing money,
Yeah.
okay, at the discount rate, to pay for the current services that are going to be gone, that future generations are going to have to pay for it. So I hope we can maintain that discipline.
So as you can see, and I will say that that's part of why we do this policy, is we have a policy that guides the council and staff in our work and our investments on this. And not every year, but every 3 or 4 years, do a really in-depth look to make sure, are we in the right place? To, I think, Councilmember Philseth's point, it's very important we appropriately place ourselves on this curve. It doesn't necessarily need to be today, since we are long-term investors, but we do need to keep that policy question at the forefront of our mind and adjust over time as needed.
I have a question. So do you use just one strategic way of investment for the different assets, like equity, fixed income, cash? Can it be different?
Different investments or?
Different strategy in terms of whether it's moderate, conservative, moderate.
Oh,
Or
similar, yeah, what maybe Matt was describing in terms of blending Sherbet 1, Sherbet 2, only mapped over here.
Mhm.
Absolutely. So we do have the flexibility. I mean, if we were to sort of maybe really pinpoint, if 30 to 70 was too cold and 50-50 was too hot, maybe something 40-60, we could certainly do that. Something else that we could do also, and we do this for, I don't know, maybe about 24 agencies, is that within the fixed income, and sometimes clients go, well, you got $30 million just in 3 index funds. Can you do something else for us? And we can carve that out and do an individual fixed income portfolio. And so for the city of Pleasanton, that's exactly what we've done. We actually have 2 portfolios. One is we'll just call it a capital appreciation portfolio way out here, the 70-30 portfolio. But then we have sort of a shorter term fixed income portfolio. A fixed income an asset allocation policy that's about 15% equities, 85% fixed income. And then that fixed income is really much more shorter in maturity, 1 to 3 year horizon. Sort of thinking that might be the pool of money that they would reimburse themselves or send it off to CalPERS. So there's a lot of flexibility that we can explore both on the investment side as well as the asset allocation side. Yeah.
So what do they do with the 2 buckets?
What do they do, or
Yeah,
what
they
do
got
I
one
do
that's-
as a
one that's
portfolio
a-
manager?
What do they do, right? They have one that's long-term and one that's short-term.
Yep. So far, they have not reimbursed themselves on the short-term side, but it's there for them if they wish to do it. I mean, ultimately, what I think of as a portfolio manager is you have A plus B and that equals C, and and that's the portfolio. But I do manage 2 different separate mandates.
Yeah,
So I
I'm
guess
kind
that's
of,
a I'm
sorry, go ahead, Lydia.
Did you say go ahead?
Yeah.
So I was just wondering if it's worth looking into this a little bit, given there's so much volatility, right? Is it something to look into, the 70-30 or 60-40 based on something that you might recommend?
If the answer comes back after staff looks at the budget and
Mhm.
says, you know what, I can't say it's 0, but it's probably 15 to 20% that we're going to need these funds the next 5 years, then I think you can explore, looking at investment objectives that are in the outer right-hand region of this exhibit. I mean, if staff does their work and they say, God, it's going to be like 15, 20% probably in 7 years, 9 years, then, and I don't want to put words in your mouth here, but maybe even a balanced portfolio or something that's closer to your underlying pension provider might be appropriate. We have some clients that, do the proverbial beauty contest. Well, you go capital appreciation because that's the closest portfolio offering that you have high mark pars to what our underlying provider CalPERS offers. And sometimes clients do that.
Okay.
But I
Could you
really
talk
think
about-
time horizon's a driver. I'm sorry. Yes, sir.
Could you talk about other cities a bit more? Like how do our other cities thinking about this policy? Is there another city that's similar to our situation that you deal with?
I don't manage the Newport Beach. You're
No, it's my hometown and they've not done it. So.
So Newport Beach chose a strategy that didn't actually move to the 115 trust. They essentially established the Fresh Start, the refinancing practice. And it's through that they've chosen to do proactive contributions.
go
We
ahead.
do have a slide 15, which is the pie chart. So of our pension rate stabilization program clients, this is the breakdown, how they've chosen which investment to go with. Eric, so it'd be this one here. It's the page after the
Wrong one.
efficient frontier.
Yeah.
Yeah, right after. Yeah, there we go.
But I guess the next level of detail on this would be kind of how funded are they? Right.
Yeah, so the most common strategy picked by a hair is moderate, 37.50, 37.5%. But I will tell
Right.
you this, it's interesting. Y'all obviously adopted the pension program in 2017. Lalo Perez was in the seat at that point. And once he chose our program, he also chose moderately conservative because his philosophy at that point was, I want to earn a little bit better than the general fund, but I don't want to take on too much risk because I think I might need the money in 3 to 5 years. So he was thinking quite short term. And his name was so revered in the Bay Area community that I think the next 10 agencies that adopted this plan went with moderately conservative because Lalo Perez chose it. It's spelled.
Yeah,
Okay.
he's right to do that because, we're making this up as we go along and we don't know what's going to happen,
Yeah.
right? So he was right to do that.
And that was the early days of us marketing the 115 for pension pre-fund. As you can see, it's now jumped up a notch. The most common choice is moderate, the 50-50 strategy. So, food for thought.
But again, it seems like you'd want to break this down and look at what's the investment strategy versus what percent funded are they? Right? Like if somebody was
Yeah.
largely funded, they'd be more conservative.
Well, on pension, the range we see is, this is not including this last year of 21% that just got reported, was 60 to 80 with a median around 70. And Matt, you can correct me on that, but those were the numbers we were seeing. Now, when you factor in a 21% year, as you saw, you jumped up 10 percentage points from 63 to 73. And that's been pretty much the norm that we've been seeing on all the reviews. Everybody jumped up about 10%. But using the 63 as a basis, you were on the lower end of that 60 to 80% range a year ago. Okay. Again, 70 about the norm, you're at 63. So, yeah.
Yeah, I don't know if you understand what I'm asking though, but just, do you see companies picking, or do you have a breakdown of the investment strategy versus the percent funded?
Percent funded with CalPERS.
Yeah,
Don't have that chart handy.
but I would think that people that were less well funded might be in the balanced or moderate, is that true? Trying to
It would be
catch up?
good chart to put together.
Yeah.
Really, the main determining factor on their risk tolerance level choice is when do they need the money? It comes down to that almost every time. Yeah, we kind of categorize as the 1 to 3, 3 to 5, 5 to 7, and 10 years and later. So
When do we need the money?
Great question, Councilmember Koo. And ultimately, that's part of our pension funding policy that we want to converse with the council and this committee on, obviously, to refine. Right now, the pension policy, as Jesse had outlined on our on the use of funds, is that we would identify any uses of these funds as part of the annual budget process. Because as we were establishing this, we were in the nascent stages. And as Mitch identified, wanted to have about a year's worth of contributions in here so that we could mitigate the expected rate spikes that we continue to kind of manage through. And then after that, you'll also see that the city was going to start making ADPs to CalPERS. So once you hit your 1 year stabilization fund in your 115 trust, that any additional contributions, whether they're calculated based on a revised normal cost or not, would go to CalPERS directly as what's called a discretionary payment. And that would go to pay down just in general our liabilities. So it really becomes a policy question for this council on how to use this trust fund. Do we want to maintain where we've had it, which is that rate stabilization principle, which would argue that's why we have it in that moderately conservative? Or as we've discussed tonight, are we looking at either a hybrid or the full opposite, which would be we don't ever plan to pull money out of here for the next decade. It's truly a way for us to invest assets and grow our assets to meet our unfunded liability in a different investment tool. Now, it's not one or the other. I just gave you the two extremes. And we can find some place in the middle. But that's a policy question.
So you would be able to say, for example, say we want to keep 80% as savings and then have a 20%. That's just example.
Yeah, we could say something, and I'd look to Andrew and Mitch on this, but we could say that out of the full portfolio, we want to assume that 20% of it is for rate stabilization and 80% of it is for asset growth. And then they can invest that 20-80 split of the total asset accordingly. So if you're looking for asset growth, then you would invest it more aggressively. If you're looking for stabilization, I guess it all depends on the markets given fixed income right now. But anyway, in normal times, and they can ladder that portfolio accordingly so that it assumes that level of risk.
I thought I also heard him say, well, at the end of the day, it's a portfolio, so you just kind of average those together and end up
That's correct.
somewhere in the middle, right?
I did say that. I am thinking that, but it still has so much wisdom that I would love to support it.
He is right. I mean, at the end of the day, we have a pension asset. Most of it's with Matt, some of it's with Andrew, right? Except for one thing. In theory, it doesn't matter how much is with Andrew and how much is with Matt, and we're just moving back and forth between Matt and Andrew. The thing that makes it different is that Andrew sends us a bill every year. Sorry, Matt sends us a bill every year, right? And so the question is, what if something happens in the market and Matt has to send us a bill that's bigger than we have money to pay? Then we take some from Andrew. Right? My intuition is that's never going to happen. Okay, but we got to think through that, right? And make sure. And here's the reason. Okay. I mean, as long as we're saving significantly more than Matt asks us to save each year, we're not going to bump up against the rail. And if we send some of Andrew's money to Matt, right, Well, it's still going to be saved, right? I mean, it's still getting in the portfolio, earning whatever it is, whatever Matt's returns are, right? But the circumstances that we're going to get, you know, a giant cliff bill from Matt. You know, again, it goes back to all this future value versus present value stuff, right? I mean, at the most basic level, you know, the present value of our debt doesn't matter. Okay. The only thing that matters is the future value of the debt, because that's what we're going to have to pay, right? I mean, the only reason the present value of the debt would matter, other than it's sort of a yardstick to keep track of, which is imperfect anyway, because use questionable discount rates, right? Is if we were going to sell it. And we're not going to sell it. We've tried. No, just kidding, right? Right. Okay. So the kinds of things that are going to cause a big spike in the minimum payment we owe Matt, right, are the market tanks, right? You know, the market booms and so forth. That's likely to be a once in a while thing, 1 year thing. I mean, if the market tanked for 10 years in a row, right? If there were a depression, right, then we could run into a cash flow problem that way. Okay, but it seems mostly. I mean, we're at whatever, we're at 20% decline or something like that now, right? You know, let's see how big a minimum payment we get from these folks, right? And I keep saying it's from these folks. It's not really from these folks. It's from our retirees is who it's from. Okay, right? Via these folks, right? I don't know. Somehow it doesn't feel likely that we're going to get spikes and so forth, but it doesn't feel likely that we're going to run into a cash flow situation, particularly since, you know, we got $40 million in our section 115. Now you're asking the question, well, you know, if we gave 39 million of the 40 we've got with Andrew to Matt, then what's to protect us next year if Matt comes back and says, I need an extra 5 million? We're like, oh no, now we got to go back to the general fund and so forth. So that makes sense. Okay. But I'm not sure you get from there to, I need a different investment strategy for the money with Andrew as the money with Matt. It still seems like it's all part of the same thing. And so what matters is wherever that curve was, right? Where are we on the curve, right? This curve.
You like
Right.
that curve, Eric?
Well, I think, you know, I'm an efficient markets guy, right? So I'm not sure it matters that much, but it's good we're thinking about it and in the company of these folks, right?
So I guess kind of move forward in this meeting. Kylie, we're going to have a couple, well, at least one more check-in on this, right? Would it make sense for our staff to do any analysis on how likely you think it is we're going to need this money, you know, within 10 years to kind of factor into this decision?
Well, I think what will be productive is a variation of that, in that tonight, I think the point of tonight's agenda item was to really get the three of you thinking as you have, and chatting about your thoughts on the uses of these tools, different ways in which we can use these tools, and tweaks or adjustments that we may or may not wish to make to them. The policy work ahead of us is important work to continue to ensure we're on the right trajectory, but it will not be 10 years before we come back to this committee and the council to revisit. So I do caution us essentially trying to run some sort of model for the next 10 years, which we're going to do as part of long range anyway, in December. But 10 years is a long period of time. And what the long range doesn't include that I think are important factors and the exact factors that would trigger a need to use these trust funds are those just unforeseen scenarios. You have a major fire, you have a major earthquake, you have, you totally change your staffing levels in a drastic fashion. Although with our current recruiting timelines, I'm not sure how we might authorize it. We just won't have the actual bodies. But I think to the question, this council, if we can think it in that 10-year forecast, we're going to plan for it. And that's stood the test of generations, I think, in this organization. And it's really those unplanned things. It's those known unknowns that I don't think I could model, frankly.
Well, but again, I guess the way I'm thinking about this is if our policy is to continue to use internal lower discount rate, and to me, the 115 trust is for asset growth, and we should be thinking about a more aggressive investment strategy here. I mean, we have other reserves and other, emergency funds. Yeah, so I would be interested in kind of heading that direction and bringing a policy like that to council.
I would too.
That's helpful feedback for staff.
And I think that the reason is not that holy cow, bonds really suck this year, let's get out of them, right? It's we need to make sure that our assumptions for expected asset return rate, discount rate, right, match the expected return for where we are with our pension asset investment on this curve. That's the fundamental, right? Okay, and so I hear the 5.5% thing. So we should think about that because upon a portfolio that I guess I'm conditioned too old to think of new things, right? But I'm conditioned to thinking a portfolio that's 2/3 bonds is going to have a tough time reaching 5.5%, right? I mean, the variance will be lower, okay, but so I think that's the most important thing. But I think there is a case that we run into a problem where Matt needs us to send him more money over a long period of time than we have resources for. And that is, so far, at least this side of the house, not your side, right? But this side of the house is, we can't think very much at a time. So all we think about is normal cost, right? But the UAL, the existing UAL, if we cover the normal cost, the existing UAL is not getting bigger, okay? The future value of the existing UAL is not getting bigger. That's the most important. The future value of the whole is not getting deeper. But the present value of the whole, which is what we get a bill from Matt on, can grow. And so we should make sure that the payments on the existing UAL are not going to grow so big over time before they shrink that we can't afford to pay them. Now we get all kinds of charts from that from our actuary. Okay, so that's the first place to look. But they have some distortions in them, as we know, right? So we need to make sure that those assumptions are right. And I think you guys do this all day long, but that's the scenario that I can think of that where we run into a problem where, we gotta actually come up with cash from the general fund. So as long as the truth is the action that we've taken over the last few years is designed specifically so that future councils don't run into that problem, right? Right. So.
Can I
Yeah,
ask-
I'd like to see an update on what the trajectory of the UAL is at some point or other too. It doesn't have to be this week or next week and so forth, but we ought to have a, yeah. I mean, maybe you've got that. Maybe you've seen that and it's gone in one ear and out the other and so forth. That's,
I don't think we asked, what is the 30-year forward-looking forecast for the balanced strategy?
Yeah, I believe that's 6, well, you have it. Balance 6.24.
Okay, thanks.
Thanks.
So again, Kylie, I'm just trying to, are you looking for a recommendation tonight, or would there be an opportunity at a future meeting?
This is kind of like a study session, but we don't have study sessions at committees where we wanted to, this is a lot of material to cover, obviously. And so if we just kind of threw this at you and with the policy changes, it's a lot to get through. So we're stepping our way through. And so there's no formal action that the committee needs to take tonight other than to accept the update.
Right, but will we come back to this before the end of the year?
Yes,
Okay,
yes. We will be back probably right after Thanksgiving.
okay.
just out of curiosity, I'm sure it's in tons of reports, but maybe, do you know off the top of your head, what our assets are invested in now? How much is equities versus fixed income versus sort of weird stuff?
Are we talking about pension or OPEB?
Pension.
It's such a vast array as compared to, a 115 trust. Our portfolios are theirs because of the additional utilization of asset classes like private equity, real assets. I do know, and I could get you something that's much better than, for example, our annual investment report that's published online and literally is just a list of everything that we hold that would put you to sleep at night. I could get something that's probably a lot better. It would come in the form of the ALM process slide decks that they utilize for capital market assumptions 1 year prior to us doing them. So instead of 2021. And it is published on our website through our investment committee. But instead of you look, I'll just send it to Kylie tomorrow, or Jesse. I'll send it to you tomorrow. Okay. When I'm in the office, if that works for you.
Mostly out of curiosity, I think.
Yeah.
I think we've got a reasonable intuition of where, having followed it for several years, right?
Yeah.
A reasonable intuition of where you guys are on this curve, and that's really the question. Right?
I would think that if we're looking at expected return and exposure to risk, can we bring up do you know what slide number that is so I can just see it? Yeah. Yeah, it's probably most like, I'm guessing here, help from the PARS folks, probably most like balanced. Would you guys agree down there?
I would say it's somewhere in between, but I think, roughly the same zip code.
In between which two?
Balance and capital appreciation.
Okay, yeah, that's what I was thinking in my mind too. All right. Well, I wouldn't add it in for an additional consideration. It would just be part of the whole, comparing two total sums. Yeah. If you're trying to match expected return in what they're doing for your money and what we're doing at CalPERS for the money, then that would be the zip code, as he alluded to, you'd be in.
I'm less doing that as to, I'm still thinking of it as one giant portfolio, not your piece and not his piece, and sort of what's our overall portfolio look like?
Yeah, if you don't have a time horizon that's short, then that stuff on the right becomes way more appropriate.
Right.
And it's unitized as opposed to the PERF, the CalPERS fund is not unitized, and everything is tied to the actuarial assumptions on the liability side, which could just dramatically change the asset liability relationship with them. With us and OPEB, it's the same thing. You're buying units. They may be temporarily down in value, but the overwhelming mathematical probability is that they will be worth more in 10 years than they are now. And so, there's advantage in that. And then you hold on to liquidity the whole time. So, I mean, this is why people love 115 trusts.
Initially, I mean, initially some of the 115, some of the 115 sentiment was around the irrational fear that maybe our money wasn't safe with you guys at some point or other. I think that's probably an irrational fear, but some of it lingers, if that makes any sense. I mean, who the hell knows what's going to happen in 20 years in California?
Yeah, I mean, there's policy risk, there's political policy risk probably, but I mean, I've always thought of it this way: is if something that significant happens at CalPERS, it's probably also going to happen in the private sector as well. Now, I could be wrong. That could just be an inaccurate statement, but it just seems to me that there's probably some parallel in those universes.
Unfunded long-term liability picture in the private sector is quite a bit different from
True.
the state.
True. I'm just talking about the solvency of assets and companies and whatnot, based on economic realities.
No, I think you guys are perfectly reasonable as a portfolio manager. It's the other side of the house that we think needs some more scrutiny.
I mean, we've heard that for a long time now, especially in certain counties, but it's more common in places like Palo Alto, where you wouldn't have dreamed of hearing that 15 years ago here. So it's unfortunate because I'm in my 15th year at CalPERS and I have to defend that flag an awful lot. And I'm not paid extra to do so, but I try to be intellectually honest about it and rational. There are some concerns and they're valid.
Your ability to your move to put some IT in place that helps agencies experiment with the impacts of different discount rates is a small step in the right direction.
The pension outlook tool.
We initially picked 6.25% because that was Wilshire Associates number.
Yeah.
And we're aware of what happened to that number when it got into CalPERS. And we stuck with Wilshire Associates number, and that's where our 6.2% came from.
Yeah.
If there's ever a replacement from Wilshire Associates for that number, we'd like to know what it is.
Sure. If I become aware of it, I'm happy to share. I have no skin in that game. I mean, you're my client. I get paid by CalPERS, but I get paid because you pay CalPERS. So I work for them, but I work for you. I much prefer it. I like you a lot better than them. I like them both.
We work for our retirees.
Yeah. This is not a recorded meeting, is it, Kylie? Yeah. I was well aware. No, it's just, I don't agree with everything my family does. I don't agree with everything CalPERS does, but it's been a good place to work.
Okay, well,
I'm with you, Mr. Chair. I think we ought to explore where we are on this curve, and maybe it makes sense over time to shift. But I think we should be looking at not just Andrew's section of our portfolio, but I think we should be looking at the whole portfolio.
well, we're going to be running out of time, so I think we need to come prepared in November. But I think, Kylie, this is a good place to stop.
Yep.
So, I want to thank everybody for coming in today. I'm sorry I couldn't be there in person. I appreciate you all coming in, though.
And Chair Du Bois, if you wouldn't mind, if the committee would just take a motion to accept the report.
So moved.
Second.
Yep. All those in favor?
Yeah.
Yes.
Aye. Okay. So, yep, unanimously accepted.
Wonderful.
Great. All right.
Well,
Well, thank you.
Thank you, Chair. Thank you, committee, and thank you to our guests.
Right. Thank you for coming all the way.
Okay. So, meeting adjourned. Thank you.
Thanks for serving us. Thanks for serving us.
I wanted to kind of ask, how do you foresee bringing this back? I mean, for exploration, discussion and adoption?
Yeah, so Jesse and Paul are working with our actuaries right now to have updated calculations, for lack of a better word, to at least on the pension side. And then with that information, staff's going to look at our progress compared to the goals of our policy and bring forward options for revisions for the committee's consideration to that policy. And so it won't be perfect. Hopefully we'll, for lack of a better term, provide a menu for you to kind of pick and choose from based on your feedback today, based on your feedback from previously, and based on our conversations, obviously, with our experts, and then have the committee deliberate on which ones they want to recommend to the full council.
That helps the picture.
Awesome. So that'll be next step. Next step will hopefully be tangible.
So Kylie, I thought that was the end of the meeting. You said there's another item.
Just the next one is the schedule, I think. If I look at the agenda, this, what is it called?
Future meetings and agenda.
Thank you.
Yep.
Yep, I think that's it. And so I think our next meeting is November 15th. Is that correct? Yep, November 15th. And that's it.
Okay, cool. Great. Thanks. Meeting adjourned.
Thanks, everybody.
Thank you.